Assalamu alaikum once again, and today's session about the SBR, that is about three accounting standards, and I will discuss or review the accounting standards because I have used the term review because the standards for today's session is about the F7 caliber. So number one, we have to consider or we have to discuss the number one accounting standard, that is IAS 16. That is property, plant and equipment. I've already shared a document with you about for a quick review of this property plant equipment matter. So I will also make a quick review for the property plant equipment because in F7 you have enough knowledge about all aspects related to the property plant equipment. Number one, based on yes. So number one, property plant equipment, that is about some asset related standards, and the important point is that because this accounting standard is based on the concept behind the conceptual framework, because most of the accounting standard is based on the conceptual framework, of course. So what particular conceptual framework aspects need to consider here? Number one, definition of asset. That means asset definition, that's any resource controlled by an entity. Number one, then controlled by an entity. Number two, from which the future economic benefit is probable. Future economic benefit is more likely probable. And number three, the value can be reliably measured. That's called asset. But particularly if the asset is tangible, and for the purpose of business usage, like production, administration, marketing, all these, not for the purpose of sale, not for the purpose of trade, not for the purpose of capital gain, not for the purpose of nearby no more usage and available for sale. No, the particular purpose is business, for production, admin, marketing and technology, etc. And its future economic benefit expected more than a year. So we will normally consider this asset as non-current asset and property, plant and equipment. So with respect to the conceptual framework, the important aspect is the term asset. Furthermore, conceptual framework is also considerable in this accounting standard, but we will discuss time by time. Candidate, very important thing, you have to consider that whenever you study any of the accounting standard, whenever you study any of the accounting standard, normally the accounting standard sequence, the accounting standard sequence is like that. Number one, definition, any accounting standard for your property, plant, equipment, intangible assets, so on. Most of the time, the sequence is this: definition, recognition, measurement, right? Measurement, classification, presentation, and disclosure. Normally, any of the accounting standard, most of the time having this sequence. For example, let's take an example of this accounting standard, IAS 16, that is property, plant, equipment. So first of all, it belongs to asset. So asset are many more, like inventory is also an asset. Investment property is also an asset. Intangible is also an asset. But what assets are categorized or defined as a property, plant, equipment? If some assets meets the definition of property, plant, equipment, then welcome to IAS 16 accounting standard. Then we will recognize that asset or the property, plant, equipment with the recognition criteria of property, plant, equipment, IAS 16. The assets measurement initial and subsequently according to IAS 16 if it meets the definition criteria. Classification according to IAS 16. Presentation according to IAS 16. Disclosure according to IAS 16. All these aspects. So we will always follow this sequence. That's important. Huh? This is important. Now next thing. If IAS 16 is a part meets the definition of assets, so what asset are property, plant, equipment? So accounting standard explain that tangible assets, purpose for the business purpose for the usage like production, admin, and marketing and all else, and the future economic benefits more than air. And then we will declare with the classification of the non-current asset with property, plant, equipment. The second thing is that, and I know that you people know very well. You people know very well about these all things in the F7, but it's just a quick recall about the IAS 16. Next thing is the recognition. What is the meaning of recognition? What is the meaning of recognition? Recognize means when this asset as a property, plant, equipment become the part of the books, or we can say that how it's initially recognized in the books, or make a double entry, put the accounts in the ledger. That means welcome to accounting. So property, plant, equipment recognition criteria is more or less equal to the asset definition. Means we will recognize the asset as a property, plant, equipment if it meets the definition and recognition criteria. Recognition is that property, plant, equipment controlled by entity. For example, if a company having a building, and let's say control means ownership. Control means ownership. Candidates, 1 minute please, because prayers is going on here. 1 minute break please. So continue with this. So the recognition criteria, it's more about the asset. The asset definition means any of the asset with the meeting of the definition of property, plant, equipment considered as resource controlled by entity. For example, if a building belongs to a company, that means for example, ownership belongs to the company. So company can say that the building as a resource controlled by entity, number one. Number two, the future economic benefit is probable to the entity. Number two. Number three, value can be reliably measured. So if these three recognition criteria meets resource control, for example, ownership. Number two, future economic benefit probable to the entity. And number three, value reliably measured. That means recognition criteria is met. Number two. That's called recognition. Recognition includes initial recognition and subsequent as well. Measurement also includes initial and subsequent. First of all, we will consider the aspect of quickly reviews initial measurement. We have done initial recognition, then initial measurement. What is the meaning of the initial measurement? How the asset will be initially measured. Means what should be the cost. We have already done this matter in the with respect to the question of IAS 37. That's initially any of the property plant equipment is measured with the three components. And what are the components? The components are purchase price. The components are purchase price, number one. That's called the invoice price with the adjustment of any discount, including import duties and non-refundable taxes. That's a part of the purchase price. Number two, adding on the directly attributable cost. What are the directly attributable costs? Directly attributable costs are those costs on which we must have to incur before starting or initiate the machine. Whatever the cost incurred. That's For example, employee benefit cost, site preparation cost, initial delivery or handling cost, installation assembly cost, professional fees, cost of testing, and IAS 37 estimated dismantling and restoration cost. So these are what the initial capitalized matter. And any of the IAS 23 qualifying asset capitalized costs. So these three costs are initial measurement aspects. Purchase price, directly attributable price or cost, and the finance cost. These are very simple. But another important point. For example, you purchase a machine. You have to initially recognize the machine with the recognition criteria and then measure according to the initial cost. But what about the subsequent costs attached with the non-current asset or the property plant equipment? If the subsequent cost about the property plant equipment is for the running cost, running and maintenance cost belongs to the property plant equipment. For example, fuel, maintenance cost, labor charging cost, that's a part of the profit and loss account. But any subsequent cost which will enhance the capability, or capacity or future economic benefit aspects, so that cost must have to be capitalized. For example, if a machine having 10 years life, but after 7 years you have incurred a cost, you have incurred a cost to overhaul that machine, and that overhauling results the enhancing of the life. The remaining life is 3 years, but after overhauling, the life become extended to 3 more years. So that's cost considered as capitalized because economic benefit has now become enhanced. That's the point. For example, you have a machine and the capacity of the machine 100 units per hour, but subsequently you have attached some more equipment to enhance the capacity or the performance of the machine, that's become 10 more units per hour. So that cost should be capitalized because that cost meets the definition of the original asset. That's future economic benefit enhance. So measurement of subsequent cost is the cost which will incur, for example, overhauling or the extra equipment cost. That's enough. But another important point, once you will measure the cost of asset initially with 3 components: purchase price plus directly attributable cost, and third one including the IAS 37 estimated dismantling restoration cost. Subsequently, you know that there are 2 models, cost model and revaluation model. It's the company's option, either the cost model or the revaluation model. The cost model means the historical cost, adjustment of the depreciation. And the candidates here, the concept of depreciation, it's basically about matching concept. It's also framework. It's about the matching concept. And what does that mean, the matching concept? Matching concept means the revenue should be matched with the cost belongs to current year. if we purchase the machines having a life of the 10 years, the matching says that we will charge as an expense of the depreciation whatever the amount of machine used during the period. Used incorporating the revenue. Use incorporating the revenue. Use incorporating the revenue. So matching. If I use the machine 1 year and generate the revenue accordingly, so the depreciation concept meets the criteria of the framework, conceptual framework, matching. Anyways, cost model. Cost means cost of asset minus accumulated depreciation minus any impairment aspect. If there are some indication aspects, you must have to test the impairment by the impairment matter as discussed on IAS 36. As discussed on IAS 36. This is important. Next, revaluation. The company has a policy either to use cost or revaluation. Revaluation model means initial cost and subsequently either the company opt the revaluation model in a behavior that the company will revalue the asset each year, or the company has an option, or the company has an option to decide the revaluation aspects when the company evaluates that or consider that there are substantial change in the revaluation. Substantial change in the revaluation. So either yearly or either significant or substantial. It's depend on the policy of the company. The standard has given the choice to the company. And we have already discussed the revaluation aspects in IAS 36 aspects, how to revalue. Either revaluation upward or downward. If the revaluation related to the downward aspect, that should be charged to the profit and loss account. If revaluation belongs to the upward aspect, that's the revaluation part of the equity reserve. That is non-distributable reserves. Candidates, there is a very much important concept here. And students normally confuse about the term revaluation and the impairment. Do remember one thing. Either the company use the cost model or the revaluation model. This is a separate thing with the as compared to IAS 36. If any of the asset we use and we measure either cost or revaluation, if the circumstances has developed belongs to impairment, either internal or external factor, we must have to test according to IAS 36 criteria, either to impair or not. So IAS 36 impairment criteria, it's no connection with IAS 16, either cost, either revaluation. This is the one thing. Yes, if the asset become impaired of any revalued asset, first we have to adjust the impairment loss with the revaluation aspect, as we have already discussed in the IAS 36 lecture. So that is the matter. Number two, if the asset, property plant equipment can be categorized as a land or other than land. Land or other than land. Land is non-depreciable, non-current asset. And other than land is a depreciable asset. If a depreciable asset like building, property, plant, whatever, revalues and subsequently we will make a depreciation. In case of upward revaluation, some of the part of the revaluation belongs to equity. In future, definitely upward revaluation, then the depreciation will be charged more. Again, with respect to the F7, it's the company policy either to use the policy of excessive depreciation, yes or not. It's totally company policy either to use the excessive depreciation or not. For example, let's take an example. Let's take an example, a very quick. For example, 1st January 2015, we purchase a plant with a cost of $100,000. Let's suppose we are using the depreciation straight line, depreciation SL straight line, 10 years. Okay, and 2015 end, year end, that is 10,000. And the book value, it's become 90,000. Due to any reason, the company has decided to shift the cost model to the revaluation. Shift the cost model to revaluation. And 2015, the revalued amount now become 1 moment please. $108,000. Sorry, 126,000. So it means the revaluation reserve, that is 90 minus 126, that is 36,000. Number one. So of course, in income statement we have charged the depreciation expense 10,000. Number one. Number two, statement of financial position, non-current asset and the property plant equipment, that is 126,000. And then equity revaluation reserve, that's equals to 36,000. Now 2016, yes, no doubt about it. No doubt about it. Depreciation expense per year should be, that is 126,000 divided by 9. And now become 14,000 per year until unless the value become revised. We have to consider this point that our per year depreciation now become increase. Yes, of course. No doubt about it. But the important issue is that excessive depreciation. There are two choices. Yes, no. Transfer to retain earning. Transfer to retain earning. It's totally company choice. That each year revaluation reserve transfer to retain earning. Yes, no, yes, no. It's totally the policy of the company. Let's say this is part, this is 1, this is 2. Let it be complete. Number 1. So value opening, and that was 126,000. Yes means transfer to depreciation, huh? Or transfer to revaluation reserve. Minus 14,000. For example, the value of property has not changed substantially. Now the value that should be reported of the property plant equipment, that is 126 minus 14, that is 112. And how about the income statement? Depreciation expense, that is 14,000. And statement of financial position, what is that? How much is that? That is non-current asset, property plant equipment, 126 minus 14, that's 112. That's important. And revaluation reserve, the company has a policy to transfer it. So that means one of the aspect transfer revaluation reserve to retain earnings. So normally 14 depreciation excessive is 4,000. So we have made a transaction, revaluation reserve debit and retain earnings credit. That's 4,000. And the revaluation reserve, that was 36 minus 4, that is 32,000. 32,000. That is the point that we have done. In case situation number 2, in case situation 2 means no transfer to retain earning. All of the things are same. All same. But revaluation reserve, that's equals to 36,000. That's all. That we have done one point now. And another important point that I wanted to discuss. Candidates, a part of transfer to revaluation, a part. If this asset revalue on year-to-year basis, or like this situation, not year-to-year basis, based on some significant aspects. Do remember, if there are some indication of impairment, we will test the impairment test. We will test the impairment according to IAS 36. Irrespectively, either we use cost model or revaluation model. Because in revaluation model, we will consider only the market value. But the company's assets potential, it's not the market value only. You know that? How can we, you remember that how we measure IAS 36? Carrying amount versus recoverable amount. And the recoverable amount includes fair value less cost to sell or value in use. There is no concept of the value in use or NRV in the revaluation model. So these are two separate things. So must have to remember one thing only. If any corporate, any company use revaluation or cost model, it's irrespectively of IAS 36. If there are some indication related to the external or internal matter of impairment, we have to test. If that test qualify carrying amount greater than recoverable amount, then we have to impair the asset. Number one. Number two, once we impair the asset, yes, we will consider that. If that asset become impaired, and having some revaluation reserve, we will make some impairment adjustment with revaluation reserve. That's all. So that's a quick review. Definition, recognition, measurement, classification. It's very simple. Property, plant, equipment is classified as a non-current asset. It's a non-current asset in the balance sheet because it's normally time period more than 1 year. Because if it's time remaining only 1 year, means for example 9 years has gone and 10th year will be the last year, then we will classify in the current asset. That's machine, plant, whatever. And that's all about the quick review of the IAS 16. We will use this topic in our lecture of the SBR in the exam caliber question later on. Now, this is done. This document I have already shared with you. If you don't have, do let me know. I think so that's before the class I have already shared with you. Do review this document, and this is the property, plant, equipment aspect. Now the